risk management, if you will, is this process of sort of identifying and analyzing and then ultimately mitigating the potential downsides of an investment while balancing the reward, right? I think that's the best way to put it, is this notion of, when we talk about risk management, it's all about balancing risk and reward. Because at the end of the day, when you think of it, risk is in fact inseparable from return. Risk is inseparable from what we do on a regular basis, not just about our finances, but think about your daily commute. You're taking a little bit of risk there, going and getting out on the roads and heading to your job, particularly if you're having to travel I-4 these days. And so if that's the case, what do you do to mitigate that risk? Well, you hopefully drive more carefully, pay more attention, stay off the phone, all that kind of stuff. And then that helps to reduce down the likelihood that you're going to die in a fiery crash on the interstate. So similarly, risk is also pretty important when it comes to finances. Any investment that you put your money in is going to have some degree of risk. Obviously, the lowest risk is typically if you are investing in U.S. Treasury bills, those kinds of things, or if it's cash at a bank. And then sort of on the other side of the equation, the sort of the higher risk categories would be things like emerging stocks, emerging market stocks, and then some of the other, kind of more crazy strategies out there with options and straddles, and then we'll throw in crypto into that category as well. So that kind of gives you the spectrum. Typically higher risk will come with sort of higher reward. Let's hope you're getting a higher reward for the risk that you take when you're taking on more risk. But from an individual's point of view, it's important to be able to sort of stomach that, right? I mean, if you're chasing return and creating an excessive amount of risk and you're waking up in the middle of the night and your stomach's churning, then perhaps you need to engage in a little bit more risk management as it relates to your personal finances. So one of the ways in which you do that is, you kind of look at this concept. There's a way to sort of the standard classic way to sort of measure risk in a investment portfolio involves looking at a concept called standard deviation. Okay, so what standard deviation is, simply put, is that's sort of like looking at sort of a dispersion of the returns of a particular investment over time, right? So it's sort of a statistical thing that looks at sort of how the returns vary from one period to the next versus the average, right? So we'll give you an example. So let's say you've got an investment that on average has an annualized return of 10%, right? But yet that investment can swing by 40% on a regular basis. Hence the standard deviation is quite high. So to get the 10, right, then you've got to be comfortable with these swings of 40% on a somewhat regular basis. On the flip side, if there's another investment that, maybe it doesn't make as much as, let's say, that 10%, maybe it only makes 9%, but those swings, instead of being 40%, well, those swings are only about 15%. So that's a good example of where risk management comes into play, and beyond just, okay, I've got this much in stocks, this much in bonds, and this much in cash. That obviously is a very classic way to manage risk, because stocks generally have a potential for greater appreciation but more volatility. Bonds, less return but less volatility. Cash, obviously not much of a return, but you don't have to worry about any kind of volatility on it. But beyond that, even in the different categories, you can have in specific investments that would have a much greater level of volatility. And the traditional way, of course, to measure that is through standard deviation. So that concept of standard deviation, which is a very technical kind of concept when it comes to the financial world, really does help folks to understand sort of the volatility of their potential volatility of their investments. And then that obviously allows you to make more informed decisions. And this applies to whether you're thinking about your individual situation. It also applies to the economy as a whole, right? I mean, if you think back to sort of the Great Recession of 2007, 2008, I mean, the thing that sort of precipitated all of those dominoes falling was that you had a bunch of mortgages that banks were giving to people without really any regard for their credit rating or their income. I remember those days, frankly, quite well. The expression that I would use back then is, well, if you can fog a mirror, you can get a mortgage. And at the end of the day, that was almost what it was. So guess what happens then if you're doing that from a lending perspective? Chances are you are lending to folks that would be not highly likely to pay you back. And so consequently, a much higher risk that then becomes part of the overall economic system. And then when that risk comes home to roost, so to speak, then you wind up having a significant economic event. So some important things to really kind of be thinking about when it comes to risk, what it is, how you look at it, how you measure it. And then lastly, when we think about some of the key takeaways as an individual investor, and we talk a lot about this in our book, Next Gen Dollars and Cents, soon to be released companion workbook here at the end of this month. So you're going to be hearing more about that here in the episodes ahead. But one of the sort of core tenets of what we talk about in the book is this notion of diversification, right? Obviously, spreading your investments across stocks, bonds, cash, each one of which serves different roles in the portfolio, helps to diversify, and then that diversification helps to reduce risk. Another part of risk management is what we alluded to in the past, and that's sort of the stomach test, what we like to refer to as understanding what your risk tolerance is, right? It's one thing to say, hey, I'm looking to get a return, but I'm going to literally throw up if I see the portfolio go down in value by 5% or 10% or whatever the number is. So it's important to understand what you as an investor can tolerate. And some of that involves setting sort of clear financial goals and sort of regularly reviewing the plan. Obviously, we would recommend, and this may be somewhat self-serving, but meeting with a fiduciary financial planner to help personalize that strategy and to work at making sure that there's a good understanding of what exactly you need to do to help manage that risk as best as possible. Look, at the end of the day, every investment has risk. It's just a function of balancing out the reward that you're looking for versus the risk that you are comfortable doing. And for that, you really do need to have a deeper analysis into the underlying components of your portfolio. That's why we're big proponents of doing things like x-rays of people's portfolios that really help to quantify that and come up with things like standard deviation and the like that gives us an insight into the risk in your portfolio. So with that, we're going to take a break and continue on the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning.